There is a $600 trillion market silently wrapped around the global economy, bigger than stocks, bigger than real estate, bigger than every currency on earth combined, yet almost nobody understands it. A market so dangerous that Warren Buffett called it financial weapons of mass destruction. A market responsible for the collapse of Lehman Brothers, the bailout of AIG, and the near death of the entire global financial system in 2008. Back then it was worth $60 trillion. Today, it's 10 times bigger. And when it blows, not if, but when, there will not be enough money in the world to stop it. This is the story of derivatives. The invisible, complex, high-speed bets controlling every modern financial system on Earth. And why the next crisis won't look like 2008. It will be much, much worse. Most people hear the word derivatives and their eyes glaze over. That's exactly how the financial world wants it. Because if the public truly understood this system, the global outrage would be unstoppable. So what is a derivative? A derivative is a bet, a contract whose value is derived from something else. A stock, a bond, oil, wheat, interest rates, a currency, a credit event. Even the weather sounds innocent until you realize something. You don't need to own the thing you're betting on. It's like buying insurance on your neighbor's house burning down. You don't own the house. You just get paid if it burns. And the more houses at risk, the more people make bets, the more explosive the system becomes. Here's the cleanest explanation you will ever hear. Futures a bet on the future price of something. Options are right, but not an obligation to buy or sell something later. Swaps trades of cash flows like swapping a fixed interest payment for a floating one. Forwards custom agreements to buy or sell something in the future. These instruments were originally designed for hedging. Farmers hedging wheat prices, airlines hedging oil, corporations hedging currency moves, but here's the twist. Hedgers are not the ones dominating the market. The market is dominated by banks, hedge funds, and institutions gambling with borrowed money using derivatives to amplify profits through insane leverage. If a bank enters a $100 million interest rate swap, it might only put up $1 million in collateral. That's 100 to 1 leverage. A 1% move, the collateral is gone. A 2% move, the bank owes more than it has. Multiplied this by thousands of contracts, across dozens of banks, across dozens of countries, and suddenly the financial system becomes a house of cards. One wrong move and everything collapses simultaneously. The 2008 crash didn't begin with derivatives. It began with subprime mortgages. But derivatives are what turned a housing bubble into a global catastrophe. Exhibit A. Lehman Brothers. Lehman had $639 billion in assets, $613 billion in liabilities, and $35 trillion in derivative exposure. When mortgages started failing, their hedges broke, their collateral evaporated, counterparties demanded cash. Lehman didn't have, no bank would lend to them. Markets froze when Lehman died. The world nearly went with it. Exhibit B. AIG sold nearly $500 billion in credit default swaps, insurance on mortgage bonds. They collected premiums, never expected defaults, never set aside capital. When the crash hit, AIG owed more than it was worth. Its credit rating collapsed. Derivative contracts forced immediate collateral calls. AIG's losses were so massive that the US government had to inject $180 billion not to save AIG, but to save the banks that AIG owed money to. The real bailout was Goldman Sachs, Merrill Lynch, Bank of America, Deutsche Bank, and dozens more. The entire system was so interconnected that one institution's failure required saving all of them. That's the power and danger of derivatives. In 2008, the derivative market was $60 trillion. Today it's over $600 trillion. To visualize this, global GDP equals $100 trillion, derivatives equals $600 trillion, meaning the derivatives market is 6 bigger than the entire world economy. If only 5% of it implodes, that's $30 trillion in losses, 3 times the cost of the 2008 bailouts. There is no central bank, no government, no rescue plan, no money printing machine powerful enough to absorb that. Interest rate derivatives, $500 plus trillion, the biggest ticking bomb. Why? Because interest rates have been rising faster than at any time in 40 years. Every rate hike creates winners, losers, and hidden losses on bank balance sheets, losses that accounting rules allow banks to hide. Credit derivatives, $50 trillion. These are the same instruments that killed AIG. Corporate debt has exploded since 2018. From $2 trillion gives $10 trillion in the US alone. Companies refinancing at higher rates will begin to default. Defaults gives payouts. Payouts gives massive losses. Massive losses gives insolvent institutions. Currency derivatives, $100 trillion. Global currency stability is fading. China, Russia, India trading in non-dollar currencies, Saudi Arabia accepting yuan for oil, BRICS expansion accelerating de-dollarization. A sharp move in the dollar could trigger a chain reaction of derivative failures. After 2008, instead of simplifying these instruments, banks made them more complex. Now you can buy options on swaps, swaps on indexes of other swaps, derivatives built on top of derivatives. This creates exponential leverage. A tiny movement in the underlying asset gives massive changes in the derivative stack, gives catastrophic losses. Even the quants who build these models can't predict how they behave under stress. In the US, 4 banks hold 90% of all derivative exposure. JP Morgan Chase, Citibank, Bank of America, Goldman Sachs, together $186 trillion in notional exposure. These are the same institutions that were bailed out in 2008, are bigger today, are more leveraged, are more interconnected, and face greater risk than at any time in history if even one miscalculates. The entire system goes down with it. After 2008, regulators promised safety using central clearinghouses, but most derivatives are still traded over the counter. Clearinghouses themselves are now too big to fail if they collapse. Every member bank collapses. They have rules to forcibly take assets from member banks to cover losses, meaning even banks that played safe could be destroyed by banks that didn't. This is moral hazard on steroids. Here's the true danger. The system didn't survive 15 years without collapse because it's stable. It survived because interest rates were low, liquidity was abundant, markets were calm, central banks printed trillions. Volatility was artificially suppressed, but the world has changed. Interest rates are high, liquidity is shrinking, inflation is unstable. Geopolitical tensions are rising, debt levels are record-breaking, the dollar system is under threat, credit markets are tightening, and financial institutions are more leveraged than ever. The system is more fragile, more interconnected, more explosive, and when the spark hits this $600 trillion powder keg, there will be no soft landing. The global financial system is sitting on top of the largest, most complex, and most dangerous structure ever created by human beings. A system built on leverage, illusion, trust, and hope. A system where one failure becomes everyone's failure. A system too big to save, and too fragile to survive another shock. The question is not if it collapses. The question is when. And whether the world is remotely prepared for the day the $600 trillion bomb finally detonates. And the terrifying part, most of it exists off the balance sheet, hidden in private agreements nobody sees. If it fails, it won't be slow, it will be instant. A chain reaction moving at the speed of code, not the speed of humans. But here's the twist that most people miss. Crises don't just destroy systems, they expose truths. The Great Depression revealed the weakness of unregulated markets. The 2008 crisis exposed the illusion of risk-free assets. Every meltdown is a mirror forcing the world to confront the lies it has been living with. And the derivatives structure is the biggest lie of all. A lie built on confidence. A lie maintained by complexity. A lie protected by the hope that nobody will ever question it too deeply. But someone will. Someone always does. And when the next financial shock hits, a geopolitical event, a debt default, a liquidity freeze, a sudden drop in asset prices, derivatives will once again be tested. The difference now is the magnitude, the speed, the scale, the interconnectedness. The entire system is wired together like a nervous system of global capital, where a tremor in one part sends a shockwave through the whole world. Some institutions will fall, some governments will panic, some markets will enter freefall, but amidst the chaos, a new truth will emerge. There will always be individuals who adapt faster than the collapse, people who understand the system's hidden rules, people who don't wait for stability, they create it for themselves. Every crisis in history has created a new class of winners. During the Depression, ordinary families who invested in land became the next generation of wealth. During the 1970s inflation crisis, people who moved into commodities built empires. During the 2008 crash, those who bought assets at the bottom became millionaires in the next decade. And in the next collapse, it won't be the loudest, the richest, or the most connected who rise. It will be the ones who pay attention now, before the shockwave arrives. Because understanding derivatives isn't about predicting a date. It's about understanding vulnerability, understanding leverage, understanding what happens when confidence breaks. Most people live as if the financial world is stable, as if governments always know what they're doing, as if markets will always rise again, as if the system is too big to fail. But here's the truth, nothing is too big to fail when belief disappears. And that is the true danger of derivatives, not the numbers, not the formulas, not the contracts. The real danger is how dependent the world has become on the illusion of certainty, when every crisis in history proves that certainty is the greatest illusion of all. So as we stand on the edge of a new financial era, one question remains: when the next shock hits, will you be a spectator or a survivor? Because the system isn't guaranteed to hold, the markets aren't guaranteed to behave, the institutions aren't guaranteed to save you, but knowledge is. Understanding is, awareness is. The world may continue pretending that everything is under control, that the numbers are accurate, that the promises will be honored, but beneath the surface, the clock keeps ticking quietly, steadily, relentlessly. And when the moment comes, whether tomorrow or years from now, the truth will reveal itself. The system won't collapse when the numbers fail. It will collapse when people finally stop believing in them. In the end, every financial system, no matter how sophisticated, No matter how complex, comes down to a single fragile ingredient: human belief. Economies rise on it, nations depend on it, and global markets crash the moment it disappears. And today, as the world stares at the massive invisible web of derivatives wrapped around the global financial system, one truth becomes clear: we are living inside a structure built on promises, not assets. People imagine that financial collapses begin with dramatic events: banks running out of cash, stock markets crashing, currencies failing overnight. But real collapses don't start with chaos. They start silently. They begin with hesitation, a pause, a doubt, a faint question whispered in someone else's mind. What if the system doesn't hold this time? That one thought spreads like a shadow, moving across traders, banks, corporations, governments, and finally, the entire world. Because once belief cracks, even slightly, every number on every screen becomes vulnerable. Derivatives, at their core, are nothing but mathematical agreements, bets on future outcomes, trades based on assumptions, promises that certain events will or won't happen. And when you stack hundreds of trillions of dollars in promises on top of each other, you get a structure so large, so interconnected, so unbelievably fragile, that the failure of one part can trigger the collapse of the entire system. Most people don't know this, most people don't want to know. But ask anyone who truly understands the system: economists, insiders, risk analysts, and they'll tell you, the danger isn't that derivatives exist, the danger is that they depend completely on trust. Trust that the counterparty will pay. Trust that the bank will honor the contract. Trust that the government will intervene at the right moment. Trust that the system will behave tomorrow like it behaved yesterday. But history shows the opposite. In 1987, trust broke, markets collapsed. In 1998, a single hedge fund almost caused a global meltdown. In 2008, the world discovered that AAA ratings didn't mean safety. The system was filled with toxic bets hiding in plain sight. In 2020, markets fell apart in days because fear spread faster than money. And each time, governments stepped in. Central banks printed money, and somehow, some way, the system survived. But each survival came with a cost: more debt, more complexity, more risk, and more dependence on derivatives. So the world's financial system didn't get safer, it got bigger, more complicated, more fragile. Today, the derivatives market is so massive, over $600 trillion, that it no longer behaves like a financial tool. It behaves like a shadow system, a parallel universe controlling interest rates, currencies, risk, and leverage. It moves faster than regulations, faster than governments, faster than anything humans can track.